Thank you for joining us today. Good morning. Welcome to today's nonprofit education series brought to you by BPM. Today's topic is on alternative investments for nonprofits. My name is Melody Olson, and I am a senior manager in our nonprofit assurance practice. I will be your moderator for today's presentation. It is my pleasure to highlight today's presenters, starting with Daniel Figueredo, who is one of our co-leaders in the nonprofit industry group here at BPM, as well as a leader in BPM's financial services practice. Daniel has nearly 20 years of experience serving nonprofit clients, working extensively with fair value and alternative investment needs, as well as working with both nonprofit investors as well as the alternative investment funds directly. Joining Daniel today is Elena, a director in our nonprofit tax practice with over 12 years of experience in public accounting. Her focus on providing tax services to nonprofits will be highlighted today as she discusses tax considerations around alternative investment funds. And we have Sue, a manager in our nonprofit assurance practice. Sue serves a wide variety of nonprofit clients, especially private foundations and environmental organizations. Today, she will help highlight accounting and reporting considerations for not-for-profits with or considering investments in alternative investment funds. So to get started today, Daniel, what makes alternative investments a relevant topic in today's environment?
Thank you, Melody, and pleasure to be here with everyone. To address your question about why are alternative investments relevant today, my main response would be, alternative investments, part of the appeal of them is that they oftentimes include strategies that are not correlated to help hedge against downturns in the economy like we may be experiencing today. That's certainly one of the appeals of alternative investments. Also, it's good when you're having tough economic times, when you're thinking about your liquidity needs. Alternative investments aren't always as liquid as you would like, so it's good to understand a bit about that as you're going into potentially rougher waters for the economy. So those are a couple of key points, and we'll cover those in this presentation. But before we do, just a standard disclaimer here, since we are talking about investments here, just wanted to reemphasize that we are not investment professionals at BPM. We don't make recommendations or endorse any particular investments, and just don't take what we have here as anything more than informational purposes. Seek your advisors for professional advice. So let's go ahead and jump right in. We're going to talk a little bit about introductions to alternative investments, and what better way to start out than with pros and cons. And let's get the bad stuff out of the way here in terms of some of the potential cons and risks of alternative investments. Some of these you may be aware of, and others maybe you haven't considered, but sometimes these investments may come with a higher fee structure than you may be used to with, say, a mutual fund or an ETF. So it's just important to understand what that fee structure looks like. And I did mention liquidity as an issue, so keep in mind that some of these strategies may be less liquid. And there's a few other items in here as well, including possible unrelated business income tax for the tax end of things, and just the cost and effort of complying and keeping track of all of these. Those all have to be factored in when you're evaluating if this is a strategy that's right for you. Moving on to the pros and upside, people often find these strategies of alternative investments appealing because, again, they're associated with non-correlated investment classes. So ideally, as some classes go down, others go up, and you overall hedge against an overall downturn or minimize the impacts of a downturn in the economy. Potentially, there's higher returns depending on how you allocate your assets and the strategies you use. There are often some premiums that are commanded because you are locking up your funds for a period of time in certain situations. So you do get to purchase certain assets at discounted prices, or probably what you would in a marketable trading situation. And then, obviously, if you're in a VC type fund, you might have access to some of those earlier companies before they become the unicorns and IPOs that bring lots of returns. So in summary here, alternative investments, mostly what we're going to be talking about today are private alternative investment funds. There are some public forms of alternative investments that you can enter into, but most of the matters that we try to focus on for our clients do come around with the private funds. Also, when we talk about alternative investments, it's often associated with those types of strategies that are not just your typical buying of stocks and bonds, going along on stocks and bonds. So the different types of strategies. Also, in today's world, there's an increasing competition out there for new financial products and strategies. So you're seeing more and more public types of alternative investment funds, whether it's mutual funds or ETFs, that are using endowment-like strategies and portfolio construction to achieve something similar, maybe at a different cost structure. You're seeing new types of assets like Bitcoin and digital assets that are starting to get allocated to portfolios. There's an emergence of decentralized finance, of new types of institutions where you can make return on your money. And then you've got newer regulations from the SEC and Jobs Act and other acts where people have more opportunity to invest directly in crowdfunding or Reg A offerings, which are kind of mini IPOs, if you will, that people can generally get into. And different strategies are important to understand for alternative investments because once you understand the strategy, then you might understand some of the types of risks or considerations you need to keep in mind. But 1/3 of the opportunities here are private equity or VC. These are mostly what we consider to be closed-end funds. You hold your funds for quite a period of time. Then you've got the hedge funds down toward the bottom, which are all sorts of strategies of how trading might be executed based on somebody's latest algorithm or the way that they think they can make money for investors. And then you've got real assets, which are a whole bunch of other strategies, which can include oil and gas, real estate, other types of real assets, and those also have some particular issues around them as well. A limited partnership agreement or operating agreement or articles of association, those are all essentially the agreements for your investment that outline the responsibilities, particularly around the governance, what is the investment manager supposed to be doing. I just want to highlight here, it's called something different depending on the type of investment you're in. So again, if it's an LP limited partnership, it has a different name than if it's an LLC. And certainly for an offshore fund, it has a different name as well. The second item here, another important document, which is essentially the offering document that tells you a bit about the business plan and key provisions of your investment. That's often called the private placement memorandum or offering memorandum. Or if it's a public fund, it would be the prospectus. Oftentimes within that document or maybe separate from that document, you might have a term sheet that outlines some of the significant terms. That is also an important document for you to understand what you're getting into. Next slide, I will just highlight the first item here, which is the general partner / managing member / investment manager. Again, the term is different depending on what type of fund you're invested in. So all three of those terms essentially are what we call the fund manager. They are the one making the decisions, executing the strategy. So just keep that in mind. Then let's go ahead and go to the next slide. There's the first two items here, an open fund or a closed fund, closed end or open end. Basically, a closed end is you can't get out once you get in, so you can't really withdraw your money, versus an open end fund does allow for you to contribute more and take out money over time, depending on the provisions of your agreement. So we'll get into more details on why that's important shortly. Next up are some terms around putting money in, whether it's contributing capital or having a commitment of capital or having a capital call. All these associate with putting money into a fund. What's important that I want to highlight on the next slide relates to trying to get your money out, right? So first off, the terminology might be different again on the type of fund you have. So if it's a capital withdrawal or redemption, that's typically an open-end fund. Or if it's a distribution, that's often with a closed-end fund, but that's where you're getting your money back. There are also other provisions on this slide and the next slide about issues you should just be aware of that could prevent you from getting your money back as quickly as you would like. So whether it's a side pocket, as we mentioned before, or a provision to hold back, or on this slide, a lockup or a gate. Those are all things that you need to look out for in your partnership agreement, just so you understand what is the potential for getting your money later than you would have hoped. And these provisions are all normally associated with an open-end fund. Again, a closed-end fund, you really can't get your money out, so there's no need for these provisions. But an open-end fund, these are often in place to prevent you from taking money out if certain events occur. So with that, let's jump into a little bit more on open-end and closed-end funds. And let's start with open-end funds on slide 26, Melody. So open-end funds, as I mentioned, you can get in and get out. So this is a quick graphic here. So that's a constant evolution of contributions of capital and deploying that and investing that capital and then redeeming that capital. And that can happen over the course of the fund's life. Versus the closed-end fund on the next slide, you really have a distinct flow here. So in a closed-end fund, there's a distinct marketing period where they're trying to raise money, trying to find investors. You might have an initial close that will bring an initial group of investors in, and then also try to do subsequent closes. But once you've started the fund, then you've got essentially your commitment period where you're actually investing the money. That's typically over 4 to 6 years. Then you've got the post-commitment period, which is when you're trying to let those investments come to fruition and then eventually distribute. That can often be 4 to 7 years. It really depends on the company. And then finally, dissolution is when you're liquidating the investments or whatever you have left that you didn't liquidate during the post-commitment period. So another slide coming up on the difference between open-end and closed-end funds. Just a few items here for you, whether it's the way that you raise capital, whether there's a life to the fund or not, a little bit about how you can liquidate. And there are some nuances with how you get charged on, say, a management fee or an incentive fee. I didn't cover those two in much detail before, but your management fee is typically the fee that you get charged based on either committed capital or the NAV of the fund, that it pays for their day-to-day expenses and the costs of the employees of the general partner. The incentive allocation is really where they get allocated their performance. If they generate a lot of profits for you, then they get a good cut of that, and that's often, say, 20%. Just for the spectrum here, the hedge funds tend to be more the open-end funds. The VC private equity tend to be more of the closed-end funds. And if you're in a fund of funds, you'll have some kind of hybrid in between. On to some fund structures here. Just I have 4 examples, but before we get into that, the fund structures can they can be very simple, like a straightforward VC fund is going to be the first example. Or they can be pretty complex with offshore blockers and all types of feeder master funds. And so it's important to understand a bit about the structure, because then you can start to flag issues either around the timeliness of when you'll get information, what sort of costs you may be paying for. For example, if there's layers of funds, how many layers of cost are there that you may have to be absorbing? And then just sort of the transparency of information you'll be getting. The first fund structure we have here is just a traditional US fund, say a VC fund, for example. So in the middle, you've got the investment fund itself. Off to the left are the limited partners, of which you would be one of those. And then you've got the general partner. The general partner typically is an entity, so it's a separate fund or pass-through entity. And then it has its own partners of the members of management, if you will, that run the general partnership and make the investment decisions. And then they'll go ahead and make their investments as they see fit. A little more complex would be, say, for a hedge fund, you've got a master feeder structure, in this case in the Cayman Islands. And in this case, you might have off to the sides on the left and the right, you would have what we call the feeder funds. One would be for, say, US investors, and the other might be for foreign investors or US tax-exempt investors. And this is often helpful because this is what we would call like an offshore blocker. So and Elena will get into the details of why you have to consider unrelated business income taxes for pass-through entities. But in a Cayman structure, that might what we call block the taxable income. So that's something to just keep in mind. Then you get a little more sophisticated, and so then you have a fund of funds, which is kind of like the first example, except you're at the top layer versus there are maybe other investment funds below you that investment fund is investing in. And then lastly, there's different strategies like segregated portfolio companies, and that also looks slightly different than just a traditional US fund. So the more complex the structure, probably the less transparent you'll be able to see information in terms of the types of investments. So then that really means you have to do a little bit more digging and understanding what exactly your investment fund is investing in. Let's cover some quickly here, the different types of information on your fund agreements. When you're reading your partnership agreement, understand a bit about the fund term. Typically for a closed-end fund, it's typically a 10-year fund, but could be 7 to 15 years. And then just some items here to look out for in terms of that commitment that you're making. Moving along to capital contributions. Again, the period for which capital is being deployed is oftentimes 4 to 6 years for closed-end funds. For open-end funds, again, it really depends on the strategy that they're employing, but it typically is much quicker that they're deploying capital. And you also will have minimum contributions to keep in mind, as well as some other items. And then there's a little bit here on management fees and incentive allocations. So again, the typical management fee is 2%, and the incentive allocation is typically 20%, but again, it really can vary. And I will say, if you're in a fund of funds, you generally would try to see that there's some lower percentages because the funds that they're investing in are also charging the 2 and 20 oftentimes. And then lastly, just some key items on the distributions and withdrawals. So whether you want to just understand what your rights are as an investor, when you're allowed to get money back, if you are subject to lockup periods, how long, and what are the provisions. If I do have to give notice for getting my money out, it's important to understand that. And then as well as, can the investment manager just stop us from withdrawing our money altogether for given reasons? It's important to keep that in mind.
Good morning, everybody. Today we're going to talk about tax side of alternative investments. We won't go into details and everything you can see because we need to have a separate training for each issue. But I just want to go over the items you should pay attention to when you invest in alternative investments. Next slide. So let's say you decided you want to go and invest in alternative investments. From the tax standpoint, you need to ask yourself, how is that fund you invest in set up? Is it a corporation? Is it a partnership? Is it a trust? Is it domestic or foreign? Why it's important? Because if it's a corporation, you invest, you don't need to pick up taxable income usually. If it's a partnership, whatever fund does, it flows to you. So your portion of investments, if the fund has unrelated business income, you have to report it. If fund invests in some foreign corporations or partnership, you have to report it. Will the organization receive a K1 from the partnership? Or maybe it's a foreign partnership and you won't have a K1. How you will gather all the information you need to file a form with IRS? If there is no K1, but there is an understanding that you have to pick up a part of the income, you need to read the partnership agreement or any documents you received and see what does it say on the tax. Does it say, okay, we're not going to issue K1, but you expected to pick up your portion of taxable income? Then you need to ask your investment advisors, and they probably should ask the fund tax advisors or fund managers when you will receive the information. Because if you have unrelated business income, you might need to pay estimated tax payment. If you're a private foundation and you have to pick up income for your excise tax, you need to pay estimated tax payment. So it's not that easy just to invest and forget. Next slide, please. Let's start from the assumption the fund you invested in a partnership. First question to ask, when you will issue the K1. And funds always try to say that it's going to be without extension. If it's a smaller fund, it's going to be by that date. But realistically, just ask, when do you think I'm going to get it? Because you might get estimated K1s, but information on estimated K1s not always the same as the final K1. Next question to ask, do you know if it's going to be unrelated business income in that fund? And sometimes investment advisors do not know and fund managers do not know, and it just becomes obvious when you receive a K1, you didn't expect to have unrelated business income and now you have it. You never paid estimated taxes. You never filed an extension for 990T. How the fund is set up? Is it one layer fund? You just invest and they do the activities, or the fund is invested in another partnership and then another partnership and you have 5, 6, 7 layers. And if it's several layers, the information needs to go through to get to your fund. So that means you're probably not going to get a K1 soon. It's going to be in September. It might that you're not going to get a state K1 until later. And it's going to be really hard to get any information for estimated taxes because the fund you invested in need to get information from all the layers. Then a partnership can withhold tax on organization behalf. Need to be careful. They might withhold tax on your state income, not unrelated business income. And your organization will pay tax when there is no unrelated business tax, and you have to file unrelated business tax for state just to get money back. Next slide. Let's say the fund is a domestic partnership, which is a little bit easier than foreign partnership. You can expect a K1. You know you're getting it, that's good. For private foundations, K1 income needs to be added to your net investment income. So for financial statements, you might be using book income for K1, statements. Sometimes people will use distributions as income. For net investment income, you have to use what you see on a K1. For most of us organizations, you need to pay attention to box 20V, which will say, what is unrelated business income? Do you have any? Sometimes it won't have the number, but it will just say C statement. Then you go to footnotes and you see a page which is dedicated to unrelated business income. It says you how to calculate it. It depends on the fund, it depends on a tax preparer. You need to pay attention to footnotes because in footnotes you get all the wonderful stuff. It could be foreign filings, reportable transactions, everything under the sun. And foreign filings, you don't pay tax, but you have to report. And if you don't report, IRS penalizes the organization. And penalties are pretty high. They usually start from $10,000, sometimes it's more. Next slide, please. Oh, we are polling question number 4.
We are. So launching polling question number 4. We want to find out who here is currently filing a 990T for UBI from alternatives, or maybe who thinks maybe they should after listening to Elena's discussion on this. So again, as everybody is responding to the poll, please feel free to use the Q&A option if you have any questions for our presenters. Again, we'll try to get to them during the presentation, or if we are unable to, we will follow up afterwards. Just a little bit longer. So it looks very split right this second. It looks like about 50-50 on the yes or no from for UBI from alternatives. Let me share those results right now. So if we take out those who are joining us who aren't representing a nonprofit, it's 36% and 36% yes or no from alternatives. So very interesting results. All right, Elena.
Okay, Melody, let's go.
Let's go.
Okay. I came up with a small example of a K1. Melody, next slide, please. It's very simple. Usually you will see much more complicated K1. I hopefully the names I came up with are not real, and nobody has the name like that. The organization doesn't have name like that. But when you get a K1, let's go through the boxes and see what's important here. So before you get to income and expenses, first you might want to look how much you actually owe. So look at the box J, which will say what is the percentage, what is your ownership, what your income percentage, loss, capital. Then you want to look at K, which will show you how much debt was allocated to you as an investor. And it's important because usually when you have debt allocated, you will have unrelated business income. You want to see and pay attention to box L because it will tell you how much you contributed, how much distributions you received, what is your book income, if it's on a book basis. If it's on some different basis, it could be tax. Check that actually capital contributed during the year, it's the same as you contributed. So if you contributed 15 million and you only see 10 million, maybe you should ask the fund and you don't know what's going on. The same with distributions. If they say they gave you $500,000 and you receive 100,000, maybe you have a receivable there, and then footnotes will say you have a receivable. Maybe something else is going on. After you checked all those boxes and you saw that you're actually tax-exempt organizations that you have, and they have you in their records as tax-exempt organization, because it's important to move to the boxes which show income and expenses. Private foundations will need all this information because you have to calculate your net investment income. So boxes 1 through 11 show you income. Boxes from 12, 13 show you expenses. I didn't put anything in the credits. If you have credits, it's 15. You might have some foreign tax. It's in 16. Also, you will have distributions. And box 20V shows unrelated business income. And I put a number, it's the simplest way to see it. When you have funds of funds, usually you will see C statement, and then you go on footnotes and you will see box 1, 10% is unrelated business income, or 100% is unrelated business income. Box 5, 25% is unrelated business income. And then you need to go and multiply every box by percentage they told you. Next slide, please. So we already talked about ownership percentage because it's not only important to make sure you have it the same as you have it in a statement, but also important for unrelated business income because we have silos rule now. And it means if you have less than 20%, you probably can gather all your investments together in one silo. If you have more, you might need to look through partnership and ask questions from the partnership, what exactly the activities are. If you see on a K1 that box 1 has a number, ask your fund. And you don't see anything in the footnotes or anywhere says unrelated business income, ask your fund. Because box 1 is ordinary income. It's usually income from business. And in most cases, it will be unrelated to your mission, unless you have a special setup, which is not going to be probably with alternative investments. We already talked about that. If you have debt allocated and you don't have unrelated business income, ask your fund, is it correct? Very important, read all K1 footnotes. And schedule K1, usually 1 page. Second page will tell you which boxes represent what. Footnotes could be 20 pages, 30 pages, 50 pages. It's a lot of information. Next slide, please. So when you see a number on box 20W, that means you have to file Form 990T. If you have one K1, it's easy. If it's a loss, probably a good idea to file to preserve it. If it's income, you have to file. If it's more than $1,000. What if you have 25 K1s? Summarize all the information. Because you have to, and you need to follow Silas. So I would advise you to go and ask your tax advisor to do that. But if you want to do it, do it. You have to summarize all the K1s, follow Silas, figure out what can be offset by what, if there is capital gain or capital loss. And I put rules here for Silas. The regulations are not final and they might change. So right now, that's what we have for Silas. It may be different by the end of this year. Next slide, please. You did a lot of work. You went through the K1. Now it's time to read your footnotes. Footnotes are important because for tax-exempt organizations, you probably don't read everything which you see for individuals or corporation, but all the foreign filing, you have to read it, identify it, and file the form. Penalties are pretty steep. Every form has its own penalty. It's usually several layers of penalties. You have to look through the all K1s because sometimes you have to, for example, you have 3 funds and they invested in the same corporation independently. You will need to aggregate that information to see if you have to file. Now that we have Silas for UBTI, partnership is supposed to give us more information to help to distinguish if you have a big ownership or control of the fund, how you have to report on an entity. Next slide. So now we're gonna touch base a little bit because we can spend several hours talking about each form, what you can see on a K1. You might have a domestic partnership, nothing foreign on the face of it. That domestic partnership invested in another domestic partnership, and the second layer partnership invested in some foreign corporations. That information should be on your K1. The Form 926 is a return for US transferor of property to a foreign corporation. This form is due with organization return. It's required when a person transfers more than 100,000, usually. There could be some other instances, but usually that's when it's required. You need to look to 12 months period. So you have a date of transfer in May, you transfer $40,000, but 6 months before that, you transfer another 70. Each transaction is not triggering the 926. Transaction together triggering 926. Penalty for not filing this form is 10% of fair market value of property at the time of transfer. So if you allocated portion through the partnership $1 million, 10% is 100,000. And it's limited to 100,000 unless it was intentional disregard to comply. Next slide, please. There is another form we see, it's Form 8865, return of US person with respect to certain foreign partnership, because your partnership might invest in another foreign partnership. And you need to file this form. It's again due with organization return. The same threshold usually applies. To file that information correctly, you might need more information than you see on a K1. Hopefully your fund is good and they provided you line by line amounts what you need to put on that form. If not, you need to ask your fund. If a domestic partnership files 8865 on your behalf, you don't have to file. Next slide, please. Domestic partnership is easy. What if you invested in a foreign partnership? And sometimes it's not evident from investment advisors will not tell you unless you ask them. You invested in a foreign partnership, you have to file the same form 8865 if the threshold of the transaction is met. The problem is here that there is no K1 unless the foreign partnership files a K1. You have to obtain information somehow to file this form. Allow enough time to go back to your investor advisors, which will go back to the fund, which usually goes back to their tax preparers or somebody on the fund side to get all the information needed for that form. It could be that fund is a foreign corporation, and then you might need to file Form 5471. Usually those funds are huge and we don't see people who invest 10% or organizations which invest 10%. But sometimes you might get in a situation that you invested 10% or you accidentally invested 50 and you became 50% owner. How you can become 50% owner? Somebody tells you about this great investment. They have inside track. They sign you up and you're the first investor. Or maybe you're second investor, but you invested more than the first investor. And now you're 50% of the fund. And before it was for 30 days, and now it's at any time during the year. And when you have 50%, you have control and you have more reporting. So if you have a situation like that you know that you invested in a foreign corporation and your ownership not 0.01%, 1%, 1.5%, but pretty big numbers, talk to your tax advisor because the Form 5471 is complicated. It's changed recently. You need to report a lot of information there and you want to do it correctly because again, every time you touch a foreign filing, penalties are huge. Next slide, please. I put a small example of Form 926, what you can see in the footnotes. It's usually much bigger. If you have funds of funds, you can have 5, 10, 12 pages just for Form 926. Sometimes it's agreed because it's so much information, but just look for some identifying information such as, do you have to calculate your share based on what you see on a K1, or does the K1 footnote tell you you have to multiply the amounts you see on a K1 by your ownership percentage? And if you're not sure, ask your investor advisors or fund managers. Because you might see huge numbers there. For example, 5 million was invested, but you own 0.01% or 0.02%, it doesn't trigger. But sometimes the tax advisors for the fund would actually calculate your amount. And then it will say it's reportable to you, and it says 100,000. You have to report it. It might say 70,000, and then another K1 to the same corporation, it will be 50,000. You need to aggregate it. Usually, funds are pretty good in giving you information. They will tell you what to report, what boxes, how much was transferred, what type of transaction it was. Next slide, please. This is the area where it's a little bit tricky. You can file your foreign filings with 990, with 990T, 990PF. IRS came out and said, okay, if you file foreign filings with 990T, it is not open to public disclosure. So you don't need to include, if your 990T is open to public disclosure because you file on C3, don't include those foreign filings in public disclosure. Somebody comes and says, I want to see your 990T, no foreign filings. On a 990, IRS doesn't say anything, but in practice, we see that they usually remove it when they put it on the internet. So hopefully they're doing a good job removing those foreign filings if it's filed with 990. If you file your copy of your 990T or 990 with foreign filings with state, such as Office of Attorney Generals. Office of Attorney Generals are not that great in removing anything you give them. California office, when you file your RF1, you attach your 990, for example, they will, or because they require you to attach 990. Unless you put confidential on something, they just will put it on the website. You write them an email, it's on the website. You request something in a letter, it's usually in the website. So be careful what you submit and see what you need to submit because it's mined up on the internet. Some forms have to be filed with 990T. And I put some forms there, form 3520, 3528 for foreign trusts. So you also need to check the instructions if you're doing the preparation of the form yourself, if you need to send a separate form to the IRS or somewhere else. Now we get into the fun part. So federal part was easy. You knew you at least got the K1. You got the footnotes. You read through footnotes. You know what you need to file. State, it depends. Several years ago, funds were not really good giving you state information at all. They're getting better and better, but it might be the situation that you get information too late for estimated taxes, too late due date of the tax return because some of the state tax returns are due before your federal return. They also will give you state income tax, state source income, and state unrelated business income. If a fund is good, they give you both. And they try to give you as much detail as they can. So look through your K1s. When you see state source income, you usually don't care. It's not for you, it's for taxable organizations. When you see state unrelated business income, you care. That's what goes on your state reporting forms. Partnerships are not very good in withholding on unrelated business income. Sometimes they will withhold if you ask them to withhold or they withhold on your behalf. They will withhold on state source income, which means you might have 50,000 of state source income, 5,000 unrelated business income, and they withhold on something which is more like state source income. You overpaid, you have to pay, file the form to request a refund. Some states, not many, they don't tax unrelated business income. And when you get that state, the partnership withhold tax for that state, it's really hard to get the tax back. We tried to get some payments. You call the state and they say, we don't have a form for you to file to get it back. Go back to partnership, ask them to amend and show there is no withholding. Partnership, of course, says we don't want to amend. We have 100 partners. Maybe it's not only tax exempt organizations. Or if it's underlying partnership, they need to amend, and then everybody else need to amend. So they're not really hot on amending. So that's another question when you have funds of funds and you know that you have unrelated business income, maybe to ask your fund manager how you're going to handle that. And they will send you sometimes selection to say, do you want us to withhold or not? Partnerships, when they withhold tax, they need to give you like a withholding form because, for example, FTB doesn't like giving you credit unless you submit that form. And not all the partnerships give it to you, so you will have to ask for it. Some states do not have specific unrelated business tax forms. So organization will need to file corporate or trust state returns, and the due dates could be different and rules could be different, so you need to be careful there. Next slide. And this is just a small example how the footnote might look. So for example, here we have for California 15,000 source income, but 3,000 UBTI. You might have loss for the source income, like for the state income, but positive number for UBTI. And they also will show you if they withheld any taxes. Next slide, please. And this is the last slide. It's going to be very short because I know how many private foundations we have on the line. And usually private foundations are very familiar with K1s. They have to, because they need to go through everything, pick up all the income. So just remember, there is a different reporting on financial statement and what for financial statements and what you have on net investment income. Your column A on A9 TPF, your book income. Your net investment income, you have to pick up K1 income. When you do basis calculations, they could be different too. And you need to keep track of basis calculation because when you sell that investment, you have to calculate gain for net investment tax. Use all the K1s for all years to calculate your basis. When you have 20% ownership and you invested in something which has ordinary income and has business activity, you might trigger excess business holdings. So look at your percentage. It's important. Sometimes some percentage of your disqualified persons will be pulled in as well.
Now we're shifting to a part of the presentation where we're talking about some general operating considerations for you, whether it's thinking about your liquidity needs or other needs or different issues that could come up from investing in these types of funds. It's important to keep these things in mind. So first off, liquidity needs. I mentioned earlier that some of these funds you can't get out of, or you might have a period of time before you can get your money back. Don't enter into these agreements lightly if you expect to need some of those funds in the near term, next couple of years or few years, or make sure you factor in how that waterfall of money coming back to you might look like. In terms of investment policies, it's always great to make sure you've got all the right policies in place, particularly those around asset allocation, what your target asset allocation is and expectations, an endowment spending policy if you are a public charity that has an endowment. Even some of our private foundations create some form of a spending policy that explains how much they're looking to take out for budgeting and operational needs and grant making every year. Also, you may be a nonprofit for various reasons that has some screening criteria. Impact investing, ESG, social responsible investing, all getting a lot of attention these days. And as a result, you may end up with some criteria that you feel is appropriate for your organization, where your biggest assets are also driving your impact and mission. Then there's also faith-based organizations that also have some screening criteria potentially as well. So just make sure that is evaluated as you are trying to understand these investments a bit more. Next, you've got fiduciary considerations. One of the biggest considerations is selecting an advisor, right? So there's a lot of thought and effort that should go into that, and interviewing potential advisors, making sure you've got different perspectives, making sure your board and relevant committees, whether it's an investment committee or finance committee or endowment committee, have the right experts to help evaluate and judge the performance of your investment advisors. And this comes in different forms. So There are those investment advisors out there that will be your outsourced chief investment officer. They will actually take on the fiduciary role for you and take on some of that responsibility to make decisions on your behalf based on the agreements that they enter into with you. Or you could just have an investment advisor that's making recommendations that, say, an investment committee or management then agree or disagree with. And so that relationship may be a bit different in terms of the types and amounts of investments that you get into. And then there are some of those that get into some of these bigger multi-strategy funds that have, people have come off from big endowments at universities and started their own shops. And they essentially act as your outsourced chief investment officer as well. Basically, you invest in their very large fund of funds. As we mentioned, the board governance and oversight is very important as well. Don't forget UPMIFA, which is over 10 years old now, and still includes a lot of things that you need to keep in mind. In terms of timing issues, there are certainly some things you need to keep in mind as you're investing in alternatives. The biggest items are around your tax estimates. If you have unrelated business income, or say you're a private foundation that makes estimates on your net investment income, as well as getting your audit completed if you have to be audited, and then also the timing of your tax returns. The tax estimates is important, understanding what kind of commitments your investment funds are making in terms of providing you either final K1s or estimated K1s or some other sort of estimate. That will be helpful to you to know when you can timely complete your estimate. In some cases, if you don't have all the information, then you have to evaluate, do you just use last year's K1s as your best proxy for this year or not? In terms of audit completion, oftentimes the things your auditors are looking for are those finalized financial statements from those funds, as well as the K1s. Depending on how much of your investments are in these funds and how significant it is to the audit, you may have to look at possibly doing two different phases of audit field work. One that includes the core parts of the audit, whether it's grant making for foundations or just the regular contributions and other activities for public charities, and then maybe doing the alternative investments auditing a little bit later when things start to come in, say in July through September. Then lastly, for tax returns, the types of funds you get invested in will impact how quickly your tax preparer gets the K1s. And it can be a race to the finish line in a lot of cases because some of these tax returns do come a little bit late. Let's say it's a traditional VC fund. They probably should have a good likelihood of getting done by the March 15th deadline oftentimes, or shortly thereafter if they extend. But if you're in a fund of funds with hundreds of funds underneath you, that K1 is probably coming to you in late August, probably September, and then state reporting may come after that. So you just want to keep that in mind in terms of what you need to plan for on your end for meeting your compliance and work with your tax preparer. Again, the issue here is that these aren't funds that you can just find information on Yahoo Finance or Bloomberg. At least for the private funds, there's a bit of reliance on that fund manager. So what type of approach an auditor typically takes is a controls approach to your alternative investments. And that means, what sort of processes do you have in place to make sure that the information you're being provided is accurate and complete, and that you can rely on this fund manager? We obviously have some examples from the past that this was very evident that there needed to be more monitoring of some of the schemes that have happened in the past. So let's start off with initial due diligence. So when you're about to get invested in one of these funds, think about creating some kind of a checklist for yourself. Make sure you think about the different steps you can take to vet your potential fund manager. It can include any of these 8 items here, whether it's doing face-to-face meetings and site visits, maybe a little bit harder to do face-to-face in person, but you can do by video conference just as well nowadays. You certainly want to review all the documents and understand the track record of the fund manager. What sort of strategy, does it make sense in terms of their strategy to what type of results they're expecting? definitely do things like background checks, check references, talk to fellow foundations and endowment managers of who they're using and what they've heard about this person, and ask them and inquire if they've had any SEC examinations. Many of these are investment advisors regulated by the SEC and are subject to examination on occasion. Then look at all your key documents. So understand the organizational structure. So some of the things that I showed you earlier, just exactly what does that structure look like? Review audits that they've had in the past. There is a certain form for investment advisors called Form ADV that has a lot of useful information to look at. Then review all the other private placement memorandums or legal documents that you can get your hands on. Evaluate your costs, right? So obviously the returns are great, but you have to understand what your potential expenses are, and if you've got potential unrelated business income or compliance costs or personnel costs to help monitor all these things. And then obviously look at your liquidity and other needs and your target asset allocations. And then the best thing that we would like to see typically is before you get into one of these, you do your negotiations, write up something in terms of documentation that summarizes all the things that you did. Normally that might go to, say, an investment committee or some other individuals in management that help buy off on you getting into these investments. Now, if you're in a relationship with an outsourced chief investment officer, a lot of times they're doing this on the back end for you. So ask them what sort of process they have to do all this vetting and get comfortable with it. Then there's ongoing monitoring. You're already involved. So slide 72 here. Once you're involved, then think about how you stay up to speed on the activities of the investment fund. Don't let your guard down. Make sure you're doing your regular check-ins. You're doing the quarterly calls. Many of these funds may have an annual conference or meeting where they talk about the latest and greatest of what they're trying to do. Make sure to check things like press or other communications. Think about the service providers that they're using. So either their fund, certainly their fund auditor, their custodian, their fund administrator. Many times they will have their own SOC audits. That's usually IT associated type of audit, IT controls. And there's even a SOC 2, which is more privacy focused and cybersecurity focused. So a review of those and documentation of your review is helpful. Then you've got just basic things like evaluating changes in management or the latest on the SEC examinations of Form ADV. So really try to understand that a bit more. If you are with an OCIO or a fund of funds, for example, again, they should be having some of these protocols in their controls and processes. So understand what sort of operational due diligence is being conducted and try to understand and take credit for that where you can. And then lastly, you get to financial reporting and valuation. This is where you get your periodic information for your financial statements on the next slide. And some common practice steps here. Obviously include your governance structure in the review of performance and understand that it still makes sense for your targets and allocations. Track those capital commitments. So if you are invested in a number of closed-end funds, make sure that you're thinking about what sort of money you might have to dole out over the coming 2 or 3 years. Make sure you're tracking those tax estimates and K1s. Create a K1 summary for yourself or some other type of tracking mechanism. We're happy to give you some examples or share some thoughts there offline. Obviously, you want to gather those audits. You will send them to your auditor most likely, but you want to review them yourself, and I'll give you some tips and tricks here in a minute. And then in general practice, some basic things you can do, compare your ownership level from year to year. If you're in a closed-end fund, your percentage ownership shouldn't really change from year to year because the group of investors that got in by the time they closed all their final round of fundraising shouldn't change. So just keep that in mind versus, say, a hedge fund where your percentage ownership may shift over time. Certainly compare all the information that you get between the K1s and statements and audits. Make sure that it looks consistent. And then you may have to do some roll forward activity if, say, you have a fiscal year end that is different than, say, the typical 12/31 audited financial statements and K1 reporting that you get from these funds. So if you're June 30 year end, think about what sort of true up, if you will, to roll forward all the capital contributions and distributions, etc. Now we're getting into a few points here for you, and I won't go over everything in great detail, but so when you're reviewing the audited financial statements, the audit opinion can be helpful. You want to look for a clean opinion. You want to understand if there were any areas that were emphasized, and certainly track the basis of accounting. Sue will mention a bit about why that's important later. For the statement of financial condition or balance sheet, look at any kind of debt they have. Again, you hope the tax preparer for the fund gets everything right, but if you see debt in the fund and it's not using a blocker corporation, that may mean that you potentially have debt financed income and need to consider whether there should be UBI or not. And certainly the partner capital can give you a lot of good information to match against the information you're getting from the fund. Next slide, the schedule of investments is a great breakdown of everything they're invested in. If it's a direct fund without other layers of funds, you should be able to see the types of investments they're in. A VC fund, you'll probably see the exact companies that they're invested in to the extent that they're more than 5% of the portfolio. It'll give you information around geographies, so it could help you understand if you're invested in a foreign corporation, for example. So all these things are helpful to get from the schedule of investments. Statement of partners' capital, you can see kind of how the allocations were done between the general partner and the limited partners. Again, does it seem like that 20% allocation happened correctly, or is there any question you might ask after reviewing those allocations? Understand whether or not there were distributions or withdrawals. If there are lockups or some reason why distributions shouldn't have been allowed and you're seeing a lot of distributions, particularly from the general partner, that might raise some red flag. I might ask some questions, right? Like, why is the general partner taking money out of this fund when the rest of us can't? Then there's the schedule of, oh, I think I covered the key statements. So let's go back into the notes here. Looking at the notes, you'll get great information. If you somehow don't have your hands on a partnership agreement or other documents about where your fund is located, et cetera, the organizational note, the first footnote, often has some great information about whether it's a Cayman fund, a VC fund, does it have a term of 10 years, et cetera. So take a look at that. Take a look at some of the valuation policies that they use to value their investments. That's usually helpful. Certainly their fair value disclosures are going to be very helpful to you as well. And then if you happen to be in one of these more complex types of investments with different classes of shares and the like, there typically is a footnote for, say, those Cayman corporations that will lay out, here's all the different classes of ownership. So that can be helpful for you to understand your specific class. And then these last items here just give you a little bit more detail about provisions for capital withdrawals or carried interest or incentive allocations for the investment manager. Just more insight than maybe you might see on the face of a statement you get from them. The last couple items, just related party transactions, understanding if there's any important transactions that might be a conflict of interest that you need to understand. And then the financial highlights gives you a good snapshot of kind of the overall return of the fund over time. And that's a good footnote that's typically at the end.
In our last part of our webinar, we'll turn to accounting issues and disclosure requirements for nonprofits as you prepare your financial statements as an investor in these alternative investments. So the nonprofit investment guidance under FASB ASC 958 addresses accounting treatments for different types of investments. And as a response to the global financial crisis in 2008, there has been many efforts to increase the convergence of international financial reporting standard with the US GAAP and to really improve consistency in application of fair value measurement, as well as to increase the transparency and consistency in disclosures. And since then, a number of updates has been made toward that goal. For guidance for investments that include, among other things, investments in real estate, certain mortgage notes, venture capital funds, partnership interests, some of them that we've already covered as alternative investments earlier are scoped in the other investment section of the codification. So under other investments, for under other investments, nonprofit entities that are not institutions of higher education, voluntary health and welfare entities, or healthcare entities should report their investments using either fair value or the lower of cost or fair value. If you elect to carry investments at the lower of cost or fair value, then the declines in the value of those investments should be recognized, and their aggregate fair value is less than their carrying amounts. And recoveries, the recoveries in subsequent periods should be recorded in those periods, but not to exceed the original cost. And keep in mind that the same measurement attribute should be used for all investments. So same measurement should be used for all of your alternative investments. If you have investment in one fund, there's no significant impact, either option you elect. But once you start to have multiple funds that make up a significant portion of your portfolio, you can assess if fair value presents more accurate valuation on an ongoing basis to the readers of the financial statements. And when you elect to use the fair value option, then you will follow the ASC 820 fair value measurement. Next slide, please, Melody. Okay. Oh, I think you skipped the slide. Yeah, that one, perfect. When you, under the topic 820, it describes how to measure fair value of assets and liabilities for financial reporting purposes. Before we discuss the measurement using net asset value, I'll just do a quick recap of the fair value measurement hierarchy. So there's a 3-level hierarchy of fair value measurement, referred to as level 1, 2, and 3, with level 1 being the most objective in estimating fair values, as it uses active market quoted value. And common examples are, your corporate stocks and mutual funds. Level 2 is less subjective in that it uses similar assets in the market, such as bonds and CDs. And level 3 being the most subjective due to unobservable inputs used in the valuation. And so with the Accounting Standard Update 2015-07, it really simplified the process involved in categorizing your investments in these hierarchies. And so prior to establishing this update, ASU 2015-07, alternative investments based the determination between level 2 and level 3 in the fair value hierarchy, and it was dependent on the liquidity of the investment, which required a lot of judgment and different interpretations among organizations. Once you elect the practical expedient under the 820, you're no longer required to categorize investments in the fair value hierarchy. And along with the eliminating that level tracking requirement, entities are no longer required to provide a roll forward disclosure of your investment activities, really cutting down the time and effort required for these disclosures. And so just quickly looking forward, there's a new update that is effective for the calendar year 2020, which primarily focuses on improving and clarifying the disclosures in your notes related to your fair value measurement. So next, we'll dive in a little bit more to the NAV practical expedient. Okay. So net asset value is basically the net assets of the fund attributable to each share in the stock or the ownership interest in the member units. And in order for you to elect the NAV practical expedient, your investments must meet both of the following criteria. And one is the investment does not have a readily determinable fair value. And secondly, the investment is in an investment company. And I'll talk a little bit more about what that means. But just quickly, one exception to this rule is that if it's probable that you're going to sell the investment at a different amount from the NAV, then you are not permitted to use NAV on your financial statements at that measurement date. So in the next slide, I'm going to go a little bit more into what is an investment company. There are two fundamental characteristics that must be met. One is that it obtains funds from investors and provide investment management services, and is committed to providing investing fund services of investing funds solely for the return from capital or generating investment income, or both. And there are other typical characteristics that are not required to be met, but it will help you to understand if it qualifies as an investment company. And the easiest way for you to determine if your fund meets this criteria is to actually look at the fund's audited financial statements. And under the accounting policies, the footnote should tell you if the fund is either regulated by the Investment Company Act of 1940, or if it follows the investment company accounting guidance. Okay, next, I'll dive into some of the disclosure requirements. Okay. So here are some of the basic disclosure requirements for all assets measured at fair value. You need to disclose the valuation techniques and inputs, the valuation process that was used, and commonly the sufficient information must be provided in order to reconcile the fair value table to the financial statement position. And it's a little small on this, but this is an example from the FASB codification that you'll see other investments as its own category, and under it, you'll see other investments measured at net asset value. Great. And as I mentioned earlier, the practical expedient eliminated a lot of the disclosure requirements for level 2 and 3 assets, but it does come with its own disclosures related to the nature, characteristic, and risks of the investments. So first, you have to disclose in your financial statements if you've elected to use the NAV practical expedient. And similar to other assets, you have to disclose the fair value measurement of investments by class and any significant investment strategies around those investments. And for investments that cannot be redeemed, you need to estimate the period over which the underlying assets are expected to be liquidated. And as I mentioned earlier, there is an update, ASU 2018-13, that will be effective this year, which now requires you to, instead of estimating the period, you're required to disclose if the investee has communicated the timing to you or announced the timing publicly. And if that timing is unknown, then the reporting entity should disclose that fact that is unknown. And the next couple of the disclosure requirements are related to liquidity and some of the restrictions. And then first, it's the circumstances in which the redeemable investments become non-redeemable. And those are a couple of things that Daniel mentioned earlier. So it's investments that may be subject to a lockup period or gate or a holdback. You also need to disclose the unfunded commitments, the future obligations, and then a general description of the terms and conditions of redemption. So example, a quarterly redemption with 6 days notice. And then any other significant restrictions on the ability to sell those investments. So the next slide is an example that's provided by FASB on a tabular format that includes all of the required disclosures. And there's varying ways to present it, but this tabular format seems to be a common one across our clients. The description is the asset type. I've seeing of the clients, including in the table, the strategy of the investments, as well as a number of funds that are included if you have 10 plus funds in your portfolio. And then at the bottom, you'll see a footnote that goes into a little bit more detail on the valuation, on the strategy of the investments, as well as the redemption and restrictions on the liquidity of those funds.
Sue, I'll just chime in real quick on that page. If you go back real quick, that is one of the most important disclosures if you have a lot of alternative investments. So this is where obtaining that understanding of all the different provisions that might prohibit you from getting out as quickly as you would like need to be summarized and encapsulated. So keep note of this disclosure.
Thanks, Daniel. So as the last part of the disclosures, I wanted to just touch on the investment fees. You know, a lot of the nonprofits spent some time going over this last year as part of the new nonprofit reporting standard. And so the new requirement is that the investment returns are presented net of related investment expenses on the statement of activities. And the investment expenses include both external investment expenses, so fees that you pay your investment managers, administrators. It could also include direct internal investment expenses. For example, employee costs, such as salaries, benefits, travel expenses for personnel responsible for developing and executing investment strategy. So here it does not include salaries related to just normal day-to-day accounting and reconciling investment statements. And it also includes costs related to internal investment management, so time spent on or money spent on supervision, selection, and monitoring of investment management firms. So the nonprofit GAAP doesn't require you to allocate these internal investment expenses, but it's probably a good practice to do so to understand the full cost of managing your investments. And lastly, wanted to just touch on a few accounting best practices related to disclosure requirements around alternatives and just understanding some of the risks associated with the liquidity and restrictions. And so first, it's important that you maintain all investment agreements, not just the subscription agreement that you sign to enter into the funds. You know, pay a lot of money to the investment managers, but it is your organization, and you should you should track and maintain all of the investment related agreements. And also some of the LPAs and operating agreements have wording that might be a little bit tricky or not as explicit in describing some of the restrictions in terms of liquidity and redemption. So you want to make sure that you have a full understanding and go over them with your investment manager to fully understand them. And even though you're invested in one fund, it may have multiple classes of shares, which can have a variety of different redemption period and frequency. So you want to really understand that to understand that to get the full picture of your liquidity. And lastly, just kind of circling back to your financial statements and the new nonprofit reporting standard that now requires all of the nonprofits to have a liquidity footnote. You want to make sure that the liquidity restrictions on your alternative investments are properly reflected on the liquidity footnote of your financial statements.